ANZ Bank's CEO Shane Elliott predicts that there'll be more interest rate hikes to happen in 2023 than expected. We all know on Tuesday, the 7th of February, the Reserve Bank's going to meet up and make a decision as to where rates are going to go. In this video, we're going to talk about everything that could happen in the Reserve Bank's meeting in February, as well as where rates are likely to go. ANZ actually believes that consumer spending and the demand has remained solid in the Australian economy, which means we might actually see more rate hikes than expected. According to Mr. Elliott, the Reserve Bank of Australia would prefer to see unemployment levels increase before slowing down on rate hikes to control inflation. Shane Elliott states that more rate hikes will be necessary to slow down demand. He added that ANZ has 1 million home loan customers and that there have been many that have switched from their low fixed rates to variable rates recently, and they're handling the repayments better than home loan customers on average that are already on variable rates. Some customers, he says, may face a sudden jump in repayments as they shift to higher variable rates. However, the banks already calculate home loan repayments based on an interest rate buffer. So they add a 3% rate on top of current variable rates when they assess an application. That equates to many fixed rate customers being assessed to be able to pay loan repayments at a 5.2% variable rate, which is roughly where variable rates are at the moment. Looking at ANZ's home loan book for those behind on their repayments that are past 90 days their due date, it's at an all-time low. Previously, it had averaged about 1% of ANZ's home loan book was behind by more than 90 days. During COVID, that rose to 1.5%. At the moment, it's below 1%, so it's at a record low for them. ANZ economists are forecasting that the Reserve Bank will lift the official cash rate by 25 basis points in February and then again in March. With a likely pause in April, ANZ senior economist Adelaide Tremble says given the very strong inflation results in the December quarter, the ongoing tightness in the labour market, another 25 basis point increase is expected in March. ANZ, they're actually forecasting the cash rate to peak at 3.85%. Currently, we're at 3.1%, which means we should see another 3 rate rises this year based on their predictions.
Interestingly, Nathan, I was at a function yesterday with one of the CBA's economists, and they actually said quite the counter. So they said they're expecting only 1 more rate rise this year. In February, they're saying it's most likely to be 0.25%. They said there's actually an outside chance the RBA could supersize or do one last rate rise of 0.4%, 40 basis points, to kind of, trying to slow things down, because their view is that all these fixed rates that are coming off are going to do a lot of the work for the RBA because people's rates are going to sort of revert. They've gone a couple of years at 1.99%, and they're going to sort of come back to the variable rates, and that in turn is going to slow down sort of that inflationary effects that is having consumer spending and sort of the wage growth. And it's probably not going to be as shocking as what sort of ANZ are forecasting. I guess, who knows? It could be anywhere in the middle. There's a lot of data that's sort of due to come out as well. The X factor that the Commonwealth Bank did say, and ANZ have said a similar thing, is that wages data is accelerating. So it's a big risk locally if there's kind of high wage growth, which seems kind of frustrating if you feel like you're trying to get a pay rise and you haven't had one for a couple of years. The Reserve Bank and the bank's closely monitoring that because if your wages go up, you tend to sort of buy a nicer house, you get more expensive things, you spend that extra money, and that it contributes to inflation. And that's what they're trying to fight at the moment. So hard to know which way it's going to go. It sounds like, the rates are probably going to go up. Again, that seems like a foregone conclusion, but by how much? It's obviously not going to go to infinity is the good news here.
Australian property prices in 8 capital cities fell in January and is now 8.9% below its peak, which was April 2022. The Reserve Bank's rapid tightening cycle is the main cause. We saw a 3% increase in rate hikes that led to higher mortgage rates, which has in turn reduced borrowing power by up to 25 to 30%. Prices vary across the country, but in all markets, they are contracting. Sydney saw the largest drop of 13.8% since January of 2022. Other cities saw falls, with Melbourne falling back to its pre-pandemic levels. We're seeing the delay between changes in the cash rate and its effect on home prices decreasing in recent years. This has been demonstrated by the current Reserve Bank tightening cycle. The highest point in national home prices was April of 2022, and prices started to drop as soon as the Reserve Bank started to normalize the cash rate in May of that same year. The rapid tightening has quickly impacted credit demand and house prices. Thus, national property prices are declining rapidly, and this trend is expected to continue in the near future as the Reserve Bank is expected to continue to raise rates. We talked about it before. It's widely expected that we'll see a 25 basis point increase in February. As Jaden said earlier, we might even see 40 basis points, which will no doubt be dependent on a number of different factors that the Reserve Bank will need to take into account. Even the Reserve Bank themselves state they don't have a dwelling price target, and this is clear. However, home prices and the economy are connected, and changes in home prices can actually affect the economic outlook. Home prices might actually be considered a leading indicator as they influence wealth, consumer confidence, spending, and unemployment. A higher house turnover also can lead to more spending in household goods. Conversely, lower turnover results in less spending. The Reserve Bank will keep a close watch on the housing market for these reasons, particularly in light of the 3.9% decrease in retail trade reported in December. CommBank have also forecast that they foresee that property prices will decline 15% from peak to trough nationally, and they've remained steady on that prediction, saying that that should happen by mid this year. CommBank also expects only one more rate hike of 25 basis points. Now, CommBank's view on the housing market is straightforward. They say that the Reserve Bank's decision on rate hikes will affect the demand for credit, and with lower credit demand, subsequently we'll see home prices fall. CommBank actually says that home prices will likely decrease in the short term, but if the Reserve Bank lowers rates in late 2023, as they've predicted, home prices are expected to increase. CBA anticipate that Sydney and Melbourne, which were the first markets to experience a correction, to be the most reactive to RBA rate cuts.
So the Reserve Bank are walking a bit of a tightrope. They know that consumer sentiment is pretty pessimistic at the moment. People are concerned about, hearing about the fixed rate cliff that's coming up and different things. Equally, spending hasn't necessarily affected that because some of the rate increases that came through rapidly last year are only sort of filtering through the economy now. So they're going to have to try and decide, do they sort of overcorrect and then cause things to slow down too much, or take it easy? As we can see from the banks, there's a bit of a differing opinion there on what's going to happen. But one thing is for sure, they're saying, if the rates if they go too far, the RBA is willing to sort of step in and slow things down potentially. And they've always got enough scope there to reduce the rates if, another GFC or something like that happen in the future. So that's also why they're trying to build up a bit of a war chest there. I think overall, if you're buying a property or you're thinking about buying a home this year, it's sort of looking at your own situation, as we've sort of covered time and time again. It's not necessarily timing. Literally, no one knows when the bottom of the market's going to be or when the peak's going to happen, but it's about sort of your time in the market. So if it's a case of sitting down, if you need to try and decide, if it's better to continue renting or buying a home, you're not sure on how to calculate those repayments, then reach out to us at Hunter Galloway here. We're mortgage brokers. We can help you with buying a home, with deciding what's going to be right, with your budgeting. If you've got an existing home loan and your repayments getting a bit uncomfortable, hit us up because we can obviously help with refinancing and some cashback deals there as well to help with getting through the next 12 months.
Here at Hunter Galloway, we get home loans approved. So if you're looking for a great mortgage broker, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au, and we'll see you next time.